January 2007, 5 investment titans, the banking gang, insurance champs, AIG, and the mortgage giants, Fannie Mae and Freddie Mac. They are unstoppable, right? Until 2 years later, half of them will be history. How tiny slice of the debt pie wrecked the entire world. Hey folks, good to see you all again on Money Talks US China Beyond. Your host, Chris Lee here. Last time, we promised a deep dive into some epic financial chaos. And today is the day. We're getting to the bottom of the 2008 financial crisis. Buckle up for a wild ride through this financial thriller. It's like a blockbuster with greed, panic, twists, and crash. Here's the lineup. We're going to kick off with the housing bubble and the mortgage madness. Then watch banks go from clever to bunkers with subprime, CDS, and CDOs. Don't worry, we're going to unpack all those. Next, we're going to unpack how tiny slice of the debt pie wrecked the entire world. After that, we've got the prelude to the unprecedented tumble of the multi-billion titans, followed by Cold Spring hot summer with Bear Stearns and the 2 GSEs biting the dust. Then it's Lehman's big day and the end of an investment bank era, wrapping up with AIG and the Citi stealing the show. So grab your popcorn, pick your favorite part, timestamps. It's gonna flash on screen to zap you right to the action. Let's roll. Imagine this is the early 2000s. The dot-com bubble has just burst, leaving investors burned by tech stocks that promised the moon but delivered dust. People are tired of chasing the next big thing. They want something steady, something safe. Enter mortgages. These loans tied to real estate seem like a dream. Homeowners pay steady interest, and if they can't, the bank takes the house and sells it, often a profit. From 2000 to 2003, the U.S. home prices were climbing 7 to 8% a year, making mortgage look like a golden ticket. But here's the catch. Individual mortgages. They're a small, tiny fry. A pension fund, multi-billion, multi-trillion, or hedge fund isn't going to buy a $100,000-200,000 loan from Mia, Noah, or Ivy. It's too much hassle for too little payoff. That's where investment banks step in with a slick idea. They start scooping up thousands of mortgages from lenders, banks, credit unions, you name it, and bundle them into something called mortgage-backed securities, MBS. Think of MBS as a giant pile made of mortgage payments, and then the banks slice it up and sell the shares to investors, who then collect interest and principals as homeowners pay their loans. It was slick, right? It was efficient, and suddenly, everyone wants a piece. This MBS craze lit a fire under the housing markets. Lenders are over the moon because it's a dream cycle. You lend to home buyers, and they turn around and sell the loan, lend it again, make money again. Home buying goes nuts, and prices shot through the roof. 16% in 2004, 15% in 2005. The whole country is buzzing with real estate fever. Economist Robert Shiller, who nailed the dot-com bust, smelled a housing bubble. Not natural growth, but a hype-driven frenzy. People were not just buying homes to live in. They were betting on endless price surges. He tied it to the Great Moderation, years of calm, low inflation, and no recession since the 80s, making everyone think the party would never end. Housing caught the fever. Then Bernanke's global saving glut. Export-rich nations like China, they swimming in cash, snapped up U.S. debt, including MBS. Cheap foreign money kept rates low, turbocharging the borrowing boom and igniting the house blaze. And the U.S. government, they're all in on this too. They got this big idea. Everyone should own a home. It's the American dream, right? So they've got Fannie Mae and Freddie Mac, these government-sponsored entities, GSE, buying up mortgages and pumping out their own MBS. Investors love it. because it feels extra safe, like Uncle Sam got their back. It's like the whole world is chanting, housing price up, up, up. Here's where it starts to go off the rail. With investment banks gobbling up every mortgage they can find, lenders stop caring if borrowers can actually pay them back or not. Why should they? They're not holding the loans. They're selling them off faster like a hotcake. Lending standards out the window. Suddenly, people who never qualify in a million years, bad credit, low income, no down payment, are getting mortgages. These are the subprime borrowers, and they're a growing slice of the pie. Some of these loans are sneaky and pure predatory. Lenders dangle the teaser rates, say 3-ish% for a year or two, to hook people in. Own your home for cheap, they pitch. But then bam, the rate jumps to 8%, 9%, even 10%. Payments double or triple. And folks like Kate, a school teacher with big dreams, get crushed. Picture Kate. She's thrilled to buy her little house with a $200,000 mortgages at 4%. It's tight, but she manages. Then a couple of years later, the rates spike to 10%. Her payments explode, and she's got no way out. But the original lenders, they don't care. They've already cashed out. This wasn't just a few shady deals. It was everywhere. Everyone's banking on rising home prices to save the day. If a borrower cannot pay, they can refinance or sell at a profit. But what happens when the music stops? And insurance companies also jumped into the housing hype, selling what they call credit default swaps, CDS. Think insurance policies that pay off if borrowers default, if borrowers cannot pay. Why sell one policy when speculators want in, the people who bet? They start slapping 5, 10 policies on the same mortgages. Risky, sure. But with real estate booming, it's free money. The CDS market size rockets from $900 billion to a crazy $62 trillion. You heard it right. That's trillion with a T. More than the entire global economy at the time. Could they ever covet it if things crash? Absolutely not. Housing is on fire. Profits are pouring in. And this wild ride feels unstoppable. Well, until it isn't. As investors, we're still hungry for more mortgages. Banks cook up something even crazier. Collateralized debt obligations, or CDOs. These are like MBS, mortgage-backed securities on steroids. They take pools of mortgages, mixing other loans, car loans, construction loans, you name it, cut them into slices, they call it tranches, those fancy names, with different risk levels, and they sell them off. And the top tranches are pitched as super safe, with steady payout, AAA rating, while the bottom ones offer bigger payout but eat the losses first. Here's the twist. Subprime loans start sneaking into even the safest tranches. CDOs are so complicated, hundreds of pages of fine print, that nobody, including the investment banks themselves, really knows what's inside. It's like a game of financial Jenga, and no one knows which one is the wrong block. Who's supposed to keep an eye on us? The rating agencies, right? Moody, S&P, Fitch, they are the ones grading those securities, slapping AAA stamps on the safest stuff, less on the less safe ones. But get this, they are being paid by the banks whose products they're rating. Conflict of interest, you bet. So they hand out AAA ratings like candy, even to CDOs stuffed with junk like subprime. Investors, pension funds, small town banks, and even some of the investment banks themselves trust those ratings. They bought in, think they've got a gold. Turns out it's fool's gold. And the rating agency's slip up is about to cost everyone big time. This was a ticking time bomb, and whole systems Mortgagers, MBS, CDS, CDO was built on the shaky foundation. Housing prices would never stop rising. As long as that held, the party kept going. For a while, it worked. The risk just kept getting passed along, and the house of cards grew taller and taller. So then in 06 and 07, it all starts to crumble. Housing prices climbing for years hit a wall. By October 2007, 3% of U.S. mortgages are in foreclosure. 6% or 7% are late. Defaults pile up, especially among subprime folks caught by those killer rate hikes. Mortgage banks stuck with foreclosed homes try to sell, but there's a flood of houses and no buyers. Prices tank in 2008, down 19% nationwide. Worse in hotspots like California and Florida. Those fancy CDOs, they're toast too. Even the AAA tranches aren't safe. 75% had top ratings, but 70% default. Loss hit like a wrecking ball. Now you might be thinking, subprime was only 8% of mortgages. How did it wreck everything? Great question. The answers were contagion, leverage, and a historic run by the lenders. So first, subprime debt defaults hit like a wrecking ball, smashing the prices of subprime MBS to bits. Then like a financial domino effect, other MBS prices tanked too, and the chaos spread wider. CDS and all debt assets caught the bug. Suddenly, even the best of the best, the safest stuff, took a brutal haircut in price and value. Banks and financial companies were not playing just with their own money. They borrow. They borrow money to juice their returns. Remember that? Imagine a bank lends out $100 in mortgages or bought $100 MBS or whatever debt assets. $90 comes from depositors like you and me or other lenders. $10 from shareholders, the owner of the bank. That's 10-to-1 leverage. If those mortgage MBS debt assets lose $5, the shareholders' 10 is cut to 5. Half gone. But some people were at 30-to-1 or even 50-to-1 leverage. At 50-to-1, a $2 loss on 100 wipes out the entire $2 in capital. And the bank's toast. So even tiny bit of losses could obliterate them when they were stretched that thin. High leverage plus tanking price of debt assets, that's a lethal combo, a bomb waiting to blow. Here's where it gets crazier. Holding those toxic debt assets were not just these traditional banks borrowing from your deposits, which is covered by FDIC, insured, right? There were shadow banks, what they call shadow banks, non-bank financial outfits, including the investment banks that didn't have deposits but still need to power their credit machine. They relied on wholesale funding, extreme short-term, sometimes overnight uninsured loans from big investors. No FDIC safety net. If investors panic, the cash just vanished. And spooked they got. When subprime started faltering and asset prices started to plunge, these lenders lost faith. They demanded their cash back quick, asked for more collateral, the guaranteed assets, or just refused to lend. It's like a bank run, but for the big dogs. It kicked off in August 2007. August 2007 and spread fast, turning a ripple into a tide wave. All right, so let's zip back to January 2007. The U.S. financial world was on fire, loaded with cash and clout, ruling the scene of 5 investment titans: Goldman Sachs, Morgan Stanley, Merrill Lynch, Lehman Brothers, and Bear Stearns. Then there's the banking gang: Citigroup, Bank of America, JP Morgan Chase, Wells Fargo, Wachovia, and Washington Mutual sneaking in as the six. Tossing insurance champs AIG and BIA, MBAC, and the mortgage giants Fannie Mae and the Freddie Mac. They are unstoppable, right? Until 2 years later, half of them will be history. And it all started with Bear Stearns. June 2007, Bear's two hedge funds stuffed with mortgages are tanking. Lenders tighten up or bail. So Bear freezes withdrawals on June 7. They throw $1.6 billion at one fund, but both flop by July 31. Bear's burned. The Bank of America, their backup, ate a $4 billion loss. Short-term lenders freak, dodging mortgage-backed stuff, and troubles brewing. August 9, France's big bank, BNP Paribas, slammed the brakes on three funds tied to the U.S. Subprime mortgages. Buyers vanish, markets panic. Who's got this junk? Credit wobble, and by August 15, countrywide financial collapse rumors tanked the Dow to a 4-month low. Mid-October, Moody's and the S&P slashed subprime ratings. Too little, too late. Prices drop, and the Citigroup's Bank of America and the Wachovia admit profits are hurting. October 19, the Dow dives 367 points. No quick bounce back. October 24, Merrill Lynch drops a $2.3 billion quarterly loss, the worst ever, with $15 billion in subprime CDOs. Now trash. CEO Stan O'Neill out by October 30. Bye. November 4, Citigroup confesses an $11 billion subprime hit, and the CEO Chuck Prince bolts. Second big wick down. Morgan Stanley's up November 7 with his $3.7 billion losses, jumping to $9.4 billion by December 19. Wachovia and others pile on with losses. February 2008, panic spreads. Markets dodge securities like a municipal bond. Even the state and the local governments and student loans. Auction rate security flop. 80% of auctions fail on February 14 as banks won't bid. They don't want to buy. Chaos ramps up. February 11th, AIG admits a $5 billion subprime hit. UBS drops $11.3 billion. Peloton Partners tanks February 28. Thornburg, another giant mortgage bank, misses margin calls. March 3. And the Carlyle Fund sparks a $6 billion fire sale. By March 10, short-term lenders ditch collateral and firms crumble. Some just bad news vibes, but Ben Bernanke, the Fed chair, called it self-feeding liquidity dynamics. Fear was driving. So on March 10, 2008, rumors started to fly that Bear Stearns, with $400 billion in assets and a 33-to-1 leverage ratio, is scrambling for cash. Moody's just slashed 15 of its Alter A mortgage bonds, and the vibes is tense. Ex-CEO Alan Ace Greenberg, Ace, that was the nickname, a cigar-chomping bridge legend, hops on CNBC scoffing. Ridiculous. Bear was never, lack of money, but Bear is a scrappy survivor since 1923. Famous for bold bets on World War II railroad debt that paid off huge. Ace climbed from clerk to CEO, and passing the torch to James King in 93. Both guys, they went all in on mortgages. But oof, two subprime funds tanked in June 07. By late 07, Bear's leaning on $100 billion in short-term loans and posting its first losses. King's out by January 8. New guy Alan Schwartz gets a hot mess. By March 12, Wednesday, day 1, Bear's $18 billion cash shrinks to 12. Day 2, then a measly $2 billion by Thursday. Hedge funds, traders, lenders, they run for the hills, refuses to lend, even rejecting Uncle Sam's treasuries as guarantee. Schwartz had to dial JP Morgan's Jamie Dimon begging for help. Dimon, boss of a $1.6 trillion beasts, was not thrilled about Bear's toxic baggage. Friday, Day 3, 7 a.m. Markets wake up and the Fed pulls a rare move, something never done since 1936, shoving $13 billion through JP Morgan to keep Bear afloat. Stock plunges from 57 to 30. The Dow shed 300 points. That weekend was circus. Demon originally tried to snag Bear for $2 a share too, down from 173 just months ago, but settled at 10 after shareholders' fury, with the Fed tossing $30 billion against Bear's shaky mortgages, deal approved by March 24. Paul Volcker, the former Fed chair, like, wow, Fed is on thin ice here. Bigger trouble was coming. Meanwhile, at the same time, Fannie Mae and Freddie Mac holding $5.3 trillion, half of U.S.'s mortgage, wobbling hard. These GSEs, born federal, Fannie 38, Freddie 70, and later privatized, rode in, oops, government's got us vibe, scooping up $1.6 trillion in risky MBS from 04 to 06 with insane 70 to 1 leverage. It was all gravy until 2007's mortgage meltdown. By June 08, foreclosures jumped to 2.2 million from 1.5, shredding their books. Fannie stock tanked, half gone in a week by July 11. IndyMac mortgage bank flops that day and panic spiked. Congress swoops in July 30 with the rescue. GSEs got a lifeline. August 6, Fannie's CEO Daniel Mudd admits miserable losses. Freddie Mac's Dick Siren brags a $5.5 billion capital raise. That's a mirage. Nothing. September 4, audits scream insolvency. Essentially, they were broke. And next day, in the dull FHFA room, Treasury Secretary Hank Paulson blindsided the two CEOs. Conservatorship, which means government takeover, was there. Treasury pumps in cash, removed two top dogs by Sunday. Mortgage rates dip, stock hits rock bottom. This was wild, but it was not over. Next, all eyes were on Lehman Brothers. Lehman kicked off in 1850 by three Bavarian brothers in Alabama, is a Wall Street juggernaut by then, led by CEO Dick the Gorilla Fuld. Starting in 1969, Fuld transforms Lehman into a profit beast, dodging 9/11 chaos and hitting what 2006 called its greatest run ever. But summer 2008, trouble was brewing. With $639 billion assets and close to 40 to 1 leverage, loaded with sketchy real estate leveraged loans and the private label MBS, Lehman's wobbling as markets tank. And they're hooked on $200 billion as opposed to Bear's $100 in short-term funding. And the Fulds slow to face the music. June 9, they post a $2.8 billion Q2 loss, first since '94. And scrambled to raise $6 billion. Hedge funder David Einhorn sniffing around, calling BS. Stress tests say they need $15 billion more cash. Fuld said or claimed they had 20, but it's mostly locked up as collateral or guaranteed, so it's not free. August rolls in, and the Fulds pitching a good bank, bad bank split, hoping to snag $7 to $8 billion from selling asset management business, its crown jewel. But no luck. Korean Development Bank ditches them on September 8, tanking Lehman stock from 14 to little less than 8. Buffett and others say nah as well. By September 9, a $3.9 billion Q3 loss looms, and the JP Morgan demands additional $5 billion more guaranteed assets. Lenders get jittery by the 10th over a frantic September 12 to 14 weekend at the New York Fed. Tim Geithner, the Fed president, rallying Wall Street CEOs, only to find out Lehman was deep in broke, as fire sales and the shaky markets had tanked its asset value. Bank of America's Ken Lewis checked, but finally backed off. Barclays, the UK bank, hits a UK wall. No deal without UK government and shareholder nods. Geithner's were like, it was an unstoppable run. Sunday, the Fed tweaks rules, but it was just foam on the runway. Lehman files bankruptcy after midnight, September 15, lighting a global fire. In the meantime, Merrill Lynch, started in 1914 by Charles Merrill to bring Wall Street to Main Street, was sweating too. After 2007's mortgage bust, new CEO John Thien chats up with Ken Lewis at Bank of America. Lewis picks Merrill's thundering herd of brokers over Lehman, nailing a $50 billion all-stock deal on September 15. No government cash, just a nudge from Treasury's Paulson. Two investment bank titans crash in 48 hours. But Merrill's story wasn't over yet. Then there's Goldman Sachs and Morgan Stanley, the last two standalone investment banks. Goldman, born 1869, nearly flopped in 29 Great Depression, but bounced back under Sidney Weinberg, earning its Goldman Sachs rep with alums like Paulson. Morgan Stanley spun from J.P. Morgan in 1935, soared under John Mack's riskier bets since 2005. Post-Lehman, their stocks plunge, some from short sellers, and they're vulnerable. By Sunday, they beg to become bank holding companies for Federal Reserve supervision or protection. Approved fast, ending an investment era. Buffett tosses Goldman $5 billion a week later, a cheeky Omaha nod, while Mitsubishi UFJ's $9 billion in October, with Paulson's nudge, saves Morgan Stanley. They hang on, barely. Now, Lehman Brothers went belly up at 1:45 a.m. on September 15, 2008. Bam, markets flipped out. The Dow tanked 500 points by day's end. Worst drop in 7 years at the time. AIG stock got sliced in half. Borrowing costs doubled. Banks clung to cash, and the Fed had to pump $70 billion to chill things out. Investors bolted to treasuries, happy with a measly 0.21% yield. AIG, a $1 trillion giant across 130 countries, was next to wobble. New CEO Robert Willemstad flagged a cash crunch on September 12, blaming those $441 billion in credit default swaps. Remember the insurance policy mania? That was AIG. From AIG Finance product ensuring shaky CDOs with zero reserves, potential hundreds to one leverage, insane. By Sunday, they needed $60 billion, jumping to $80 billion the next day, Monday, as the lenders just pounced. Private rescues flopped. So Tim Geithner at the New York Fed threw an $85 billion lifeline, 11.5, almost 12% interest, snagging 80% ownership. AIG's board caved by 8 p.m. Paulson installed a new CEO. Bernanke was ticked. Taxpayers footing AIG's mess. But it was that or total collapse. And it's not done. AIG's $62 billion quarter four loss triggered a March 2009 bailout, additional $70 billion from TARP, and another loan. Fed and the Treasury for the total bill of $182 billion. Bernanke raged, slamming his phone, later gripping on TV. Taxpayers shouldn't have saved AIG's dumb bets, but collapse wasn't an option. AIG's former chairman, Hank Greenberg, even sued Fed for $25 billion loss against Federal Reserve, ticked Bernanke off even more. AIG stock never hit 10% of its old peak. Shareholder got toast. So the Lehman AIG week flipped a rough patch into epic panic. The mess just got too big for the Fed and Treasury alone to handle. Congress stepped up with TARP, a $700 billion rescue. It shifted from buying toxic MBS to injecting $250 billion into banks, $125 billion to the 9 big dogs, capped executive pay, and helped autos and AIG in foreclosures. But the House initially flopped on September 29, crashing the Dow 778 points, 7%, zapping 1.2 trillion out of the market. With the stock spook, Congress tried again and passed on October 3, and President Bush signed it. Still, the Dow shed 1874 points by October 10. Even GE had to beg Buffett for $3 billion. On Columbus Day, Paulson gathered 9 bank CEOs, JP Morgan, Citi, Goldman Sachs, you name it, for a $125 billion shot. They signed, and the Dow jumped 936 points, wildest gain in 76 years. Wachovia, 5th biggest U.S. banks, was toast by September with a $312 billion loan mess. FDIC's Sheila Bair pushed the sale. Citigroup nabbed it with $42 billion loss cap by the government. But Wells Fargo swooped in September 30 with the no government guarantee bid, sealed the deal on October 9. Washington Mutual, 6th largest bank, crashed with $16.7 billion deposit run. JP Morgan snagged it for $1.9 billion on September 25, dodging a bigger meltdown. And then comes to Citigroup, a $2 trillion titan, and with 20-to-1 leverage, nearly toppled as well. After a $25 billion TARP boost, a November 23 rescue added $20 billion more, and a $300 billion toxic asset shield by the government. Stock popped 60%, but again, never hit 40% of pre-crisis highs. Little better than AIG, but similar. Bank of America sealed Merrill Lynch deal on January 1, 2009, after another $20 billion TARP shot and $118 billion asset ring-fenced by the government, despite Merrill's $15.3 billion loss scare. What a ride. Boom. On December 16, 2008, the Fed slashed interest rates to crazy 0%, fighting a wild economic nosedive from the housing crash and the bank flops. When they run out of tricks, they unleashed quantitative easing, QE. QE1 hits late 08 with $1.25 trillion in treasuries and MBS to juice liquidity. Then QE2 drops $600 billion in 2010. Operation Twisted in 2011. And QE3 goes big in 2012 with $85 billion monthly buys. Fed just bought those mortgages, treasury, left and right. Markets chilled, stocks bounced by March 09. Housing steadies by 2012. Recessions toast by June 09. But the comeback was slow. GDP limps at 2%. Unemployment peaks at 10%. Not dipping below 5% until 2015. All saved us from doom. But folks argue it fattened rich wallets and left sneaky risks still lurking. All right, folks, we've just raced through the 2008 financial crisis, a roller coaster of epic proportions, from the housing bubble to wild mortgage party to banks getting nuts with subprime CDS and CDOs. It was a financial free-for-all. Then the music stopped. Those ticking bomb blew, and titans like Bear Stearns, Lehman Brothers, Merrill Lynch, Washington Mutual all toppled. AIG's near collapse, Citi's wobble, and Top's $700 billion rescue finally slammed the brakes on the chaos. While the Fed's zero rates and the QE kept the economy from flatlining, what a ride. Greed, panic, and bailouts galore. But hold up. While the world was reeling, some sharp players saw gold in the rubble. Next time, we're going to flipping the script to spotlight the new billionaires who turned this meltdown into their jackpot. Think savvy hedge fund bets and a knack for thriving in chaos. Grab your popcorn. We're going to dive into the rise of the crisis profiteers. Stay tuned. Thanks for tuning in. Money Talks US, China, Beyond. Hit subscribe and the bell. Drop your thoughts below. See you soon.